And also the DSCR requirement could be in the fine print. Yeah, they'll say this is what you need just for like the total proceeds you'll get from the loan. But then in the fine print, it says you need to maintain that DSCR or you're out of the loan covenant and they can call it due. And then bad things can happen. Even if you're making all your debt service payments, if you're outside of that, whatever DSCR requirement is, they can call the loan due. So,
I saw one recently where they had a bad boy carve out for the DSCR. And it's like, what's the point? You know, stuff like that.
and some things with DSCR you can't control. It's like in Texas a few years ago, yeah, we planned for things and insurance and taxes went through the roof. You can't really mitigate those. I mean, you can as best you can, but they're still through the roof, and that brings your NOI down, and then that's going to bring your DSCR down each month. And so talking to your bank when that happens or your lender when that happens is the best thing to do. Just let them know, hey, what's going on. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got Frank Patalano with me here today. How are you doing, Frank?
Good, sir.
So, the last few episodes, we've been talking about financing. We sort of kicked off this little mini series of financing with one of our favorite lending brokers, Julianne Peterson. If you want to catch that episode and catch all her cool insights, it's a few episodes back. I don't remember how many. We've talked about terms, we've talked about interest rates, we've talked about loan types, but today we're going to deep dive into another specific term, kind of like we did with interest rates, where it's the term of a loan, but it kind of means more than just meets the eye. And so we're going to deep dive into that, and that is the DSCR. Now, Frank, tell everybody what DSCR stands for.
Oh, debt service coverage ratio. And basically, are you generating enough income to cover your debt?
Yeah. So basically, a DSCR is calculated by your NOI, your net operating income, divided by your debt service. So, what does that mean? Um, so banks or lenders, I say banks, and when I say bank, I mean lender. Not all the lenders are banks, but just keep that in
True.
mind. The lender will have a DSCR requirement, and it is totally dependent on your market. It is totally dependent on the internal workings of that lender. It's not regulated by anything. It's just what their comfort level is lending money out. So think about this. If you are in a small market and get the small loans, and we've talked about it before, small loans, I guess, are more risky than larger loans. So if you have a loan less than like 5 or 10 million, it's more risky than a loan that's 15 to 20 million somehow. I don't know. I don't get it. But for them, they see that as more risk than lower amount. So the riskier the loan, the riskier the market, the higher your DSCR requirement is. Um, I have seen requirements in small markets to be a DSCR of 1.45. So that
Jason, can
means
we
you,
pause?
yeah.
Why don't you explain the exact math of, or what does 1.0 mean? How's that?
Well, so that's what I was about to jump into.
All right.
So you have a DSCR requirement of 1.45. Let's assume you have an NOI of 145,000 a year. Okay, it's really small. Um, To meet that 1.45, your debt coverage needs to be at the 1 million. So if you're over 1 million, you're going to be less than the 1.45. So you're 1 point or 145,000 over 100,000, that's your 1.45. So it's your NOI over your debt service. Um, Maybe it's 1.45 million and your debt service is 1 million. So that would be another way to look at it. But in larger markets, your DSCR can be 1.25. If it's like a brand new build, lower risk, you might get down to a 1.15. A lot of times you might hear people talk about DSCR loans where those can actually get down to zero point 0.7, but I haven't seen one of those in a commercial lending space at all. It's more residential. So
Yeah, I agree. I've seen them on the residential side. I would say that sometimes if you're repositioning or if you have the right value add, I have seen offers in the 1.0, maybe even the 0.85 with a higher interest rate, and with them knowing that you're turning the property, you're rehabbing units and you're really making it work. And they're going to look at the DSCR 6 months later or a year later based on forecasted rents.
yeah. And some lenders, they're not even going to have a DSCR requirement if they know you're doing a big heavy value add play like what you just said, where you're going to be adding you're renovating units and increasing rents. You might be going in with a 0.85 or 1.0 or whatever, and they don't care. And I think typically bridge debt I've seen haven't don't have like the DSCR requirements. Um, but I think that's pretty much the only one that I've seen that doesn't have it. Um, and also the DSCR requirement could be in the fine print. Yeah, they'll say this is what you need just for like the total proceeds you'll get from the loan. But then in the fine print, it says you need to maintain that DSCR or you're out of the loan covenant and they can call it due. And then bad things can happen. Even if you're making all your debt service payments, if you're outside of that, whatever DSCR requirement is, they can call the loan due. So,
I saw one recently where they had a bad boy carve out for the DSCR. And it's like, what's the point? Stuff like that.
yeah. And some things with DSCR you can't control. It's like in Texas a few years ago, yeah, we planned for things and insurance and taxes went through the roof. You can't really mitigate those. I mean, you can as best you can, but they're still through the roof, and that brings your NOI down, and then that's going to bring your DSCR down each month. And so, talking to your bank when that happens, or your lender when that happens, is the best thing to do. Just let them know, hey, what's going on. Remember, the lender is typically your largest investor. And so you want to keep them up to date with everything. You don't want to make them mad because when you do, bad things happen. So,
Largest and most powerful.
yeah, or business partner.
Yeah. Now, I mean, like the government, stuff like that. I would say that DSCR, the main thing to think about with this as well, though, is I'm not saying you can play with the numbers, but depending on how you categorize certain things, the number can definitely be adjusted. So if you're doing work to a unit and how are you classifying it? Are you classifying as a repair and maintenance or are you classifying as CapEx? Because if you're classifying as CapEx, then obviously that number is going to go in a different spot. It might go below the line of NOI. So your NOI looks better. You know what I mean?
Yeah, and we talked about this, how to boost the NOI or how people fudge the NOI, especially when we were looking at valuation. Because the NOI, one, it's for valuation, but two, it's also for your loan, as you can see here with the DSCR requirement. Um, but yeah, you can put things above and below the line. Maybe you hire a third party to come and do a rehab. Normally you wouldn't do that. You put that under the line because hey, that's not something you typically do, type thing. So I mean, there's all sorts of things and maybe shenanigans you can do to boost your NOI. I'm not saying it's right or wrong. I'm just saying what you can do. And also, if you take my underwriting course, you can go through a T12 from somebody selling it, and we can see what kind of shenanigans they are doing. So
I like to use the term play in gray. One of the things that one of my business partners did at one point is, and I didn't agree to it. We had to fix it. Is that he put so much of the repairs and maintenance on capex that the repairs and maintenance number on the budget when we're trying to sell caused a red flag. It's like, yeah, you need to have a certain dollar amount, and you have to think about what's a fair dollar amount to put in repairs and maintenance. So
yeah,
even if it's $275 a door annually, that number can be higher or lower, but you can't have it, especially a Class C property built in like 1980. You definitely can't have it be $50 a unit times 100 units or something.
yeah. Um, so typical DSR requirements, I've mentioned some where you might be 1.45 in a really small market with a small loan. Um, but agency debt, your DSCR requirements are roughly 1.2 to 1.25, and that's in a big market. Like I said, in our market, we were looking at agency, and they're requiring 1.3 to 1.4.
Yeah, I see a lot of 1.4s in the smaller markets. I see a lot of 1.25s in normal size markets.
Yeah. Bank loans, they're typically, again, 1.2 to 1.35. CMBS 1.2 to 1.3. Bridge loans, those are, like I said, they don't really have one. So long as you can make the debt service every month, they're not going to really care too much. Um, but the SCR also, like I said earlier, it can affect your proceeds. So
Absolutely.
if you get a loan, a lot of times we get a loan 70% LTV, loan to value, or DSCR of 1.3. It's going to take whichever's lower. It's going to figure out, you're going to have to provide a budget so it knows what the going in NOI it would be for the first year. And then that's going to have how it's calculate the DSCR going into the loan. Sometimes it'll take like the previous 12 months, sometimes the previous three, sometimes it's in the next 12. It all depends on what the lender wants to do. Sometimes they'll do projections, sometimes they'll just do like the last 3 months in OI and annualize it. But suppose your DSCR is, and I'm trying to spitball numbers, your DSCR is 1.225 and your NOI, let's say 1.25 million. So your loan can be 1 million, or your debt service can be 1 million a year. And then they'll
I've
back
definitely had that
calculate.
problem before. We had a property, I won't even mention what state it's in, but we had a property where we got a massive appraisal. The appraisal was great, but the problem was is that the NOI was too low. So they usually lend you on the lower, based on the lower calculation. And our NOI was so low that we were struggling to get a loan product to pay off what we already owed. It needed to be refied. And we ended up having some issues, but after paying extensions and taking 9 months longer than we had planned, we finally got a loan product that was able to give us just enough to close and maybe give us like 20 or $30,000 for rehab. And this was a big property.
Yeah. So, all right. So where was I? Was NOI is low. Debt service has to be a minimum or maximum of 1 million per year. Okay. Well, your LTV, maybe your LTV is coming in at 14 million, 15 million, but due to your DSCR requirements, your loan value is only going to be 12, you know, or 11 or something. So that difference is could be huge. And they're going to take the lower of the two. So, um, and to calculate all that, you just have to, I'll teach my students, run or help my clients just do the financial calculations, do them in Excel or whatever, so you can plug in what your debt service is and your interest rate, your amortization, and you can see what your value would be based off of that. So, um, anything else you can think of on that?
I mean, I'm just thinking of properties that say had a value of $10 million. and just calculating how much you can borrow, et cetera. So I mean, if you're at a 75% loan to value, that means you get a $7.5 million loan. If you have an NOI of 500,000 with a DSCR of a max of 1.25, that means that you can borrow money where your max payment is $400,000 a year, which is 30 something $1,000 every month.
Okay.
So depending on when interest rates change, and obviously we've had a lot of interest rate issues, when interest rates change, then that can greatly affect what size loan product you get.
Yeah. And so that is true. So interest rates not only affect how much you have to pay, but they affect how much you get.
Yeah, crazy.
Um, yeah, and it doesn't care what your cap rate is. Your cap rate in your market could be like a 2, but if you can't make the debt service, they're not going to give you a valuation of cap rate of 2. They'll come up with their own to get that to even out. So,
Yep, it's crazy.
um,
Well, that's all you never want to have your. I mean, I typically don't like to be investing in places where my cap rate is lower at purchase than my interest rate.
yeah, and I've put some plots on social media where the break even is for different DSCR requirements. So if you want more information on that, and maybe I'll see if I can put a picture in the show notes or something of that. So Frank, what causes DSCR to drop?
Well, the first one will be NOI.
Yeah, so your NOI definitely drops. Occupancy declines, and this is not the requirement. This is actually the ratio. Ideally, you should be calculating your DSCR every month so you know if you are hitting that point or not. You can average it out for the year, but so your NOI drops. That could be occupancy, concessions, rent decreases, um, bad debt, people not paying their rent.
Yep. Insurance increases,
Yeah,
tax increases.
expenses going through the roof.
Yep.
Another thing that can cause the DSCR to drop is you can have your NOI climbing, but if you have a floating rate and your rate is going up, that means your debt service is going up, and so that's going to drop your DSCR as well. So,
Yeah, we've
um,
definitely had. I've definitely been involved on deals where the agency debt fell apart, and then we had to look at CMBS. And even though we were able to negotiate $1 million less on the purchase, it still ended up being a problem because the interest rate was higher. So with the interest rate being higher and the DSCR being the same, we couldn't get the numbers to work.
yeah, and we've talked about other loans where you might have like fixed for 3 years and then it changes or something like that. So you might be boosting your NOI for 3 years and then all of a sudden your rates go up. Did you boost your NOI enough to cover the difference from the rate change? So,
And it's funny you say that. I have a business partner that we have deals. They're mostly like they're nothing big, like 9 units and 10 units, stuff like that. He knew that interest rates were going to be higher, so we applied extra principal every month. Not necessarily a lot, but just to try to tweak down what the payment would be after the interest rate change at the reset.
yeah. Um, Another thing that could cause it is your IO, your interest only period expires. So now not only are you paying interest only, but now you're paying down the principal. That's going to boost your debt service as well. So,
Yeah, we had a problem with that recently.
um, and then if you have any more than one of those things happening, that could cause a problem. Your insurance and taxes go up, and your IO period expires, and then bam, your DSCR is dropping.
Yeah, I mean you can
Uh,
definitely be hit multiple ways in the same on the same property. We have one property that we've been struggling to keep at above 80% occupied, which is crazy to me. But just the concept that if you're in a market where the average occupancy is in the high 80s, depending on the type of product that you're offering, you could be in the low 80s.
Yeah.
If you have the rents a little too aggressive or at the right spot even. Now, if the rents are low, then obviously you can beat the median or average occupancy of the market.
Yeah. So how do you underwrite for DSCR? You based off the acquisition. So if you're looking to purchase something, you look at the T12. Well, you analyze the T12 to make sure it's just like a good performing property for the whole year, or you can see how a property does, the trends just throughout the 12-month period, and that's a whole other issue. So you'll analyze the T12, you'll look at the projections for the first year, and then you can do some stress testing to see, well, what happens if the DSCR drops by 10%, or what if it drops below 1 or something like that. You can start seeing where things start going into play. And if you want to learn more, this is what I teach in my course. You want to check the covenant. You want to make sure that if there is a DSCR requirement throughout the whole, I guess, loan term. You can look at your pro forma to see, hopefully your DSCR should be climbing throughout the whole process, but it's not always. So then you're going to want to see where your break even point is. Oh, this is where like your break even vacancy comes in, sort of.
I was going to say, hopefully your NOI is climbing during the entire process, which in turn would help your DSCR climb 90-something% of the time.
Yeah. So, anything else on DSCR?
Not really. I'm just thinking about the concept of having, a cushion. Like, I mean, there's been deals that I've been involved in where, the DSCR might be 1.25, but we're producing a 1.6, and that always makes the banks happy and comfortable.
That makes your investors happy too, because some investors actually want to see what the DSCR is each month, and they'll actually wonder why, if you have a property that's not performing well, why the DSCR is not doing as well as it should be, and then they'll want to figure out a good way or want to see a plan to boost that DSCR up to at least 1.25, 1.3 or whatever. So, because they want to see a cushion too, because cushion means distributions. If you're not hitting a cushion, that means all of your profit is going to debt service, and so that means your cash flow is pretty much going to be zero. So
it means you're making no money.
Yep. I think that's pretty much it for the DSCR, and I think that wraps up our financing series. We did preemptively go over why you would want to refi, when to refi, and that was a few episodes ago. That was before this little financing series existed. So if you want to learn more about that, you can go back to that episode. I'm not sure what episode that is right now, though. But yeah, if you have any other questions on lending, financing, DSCR, anything underwriting in general, you can look me up on LinkedIn, Instagram, Facebook. Frank, you're on
everywhere.
I have a YouTube channel too, so if you want to learn a little bit more, you can check out my YouTube channel, and we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.